Eric will remind me. And that's
Miss the first 5 minutes every time.
I know, right? So awesome, guys. Josh is here to talk to us about investment in commercial loans. I'm gonna let Dave, most of you know Dave, but Dave Deal's on our team. He's gonna come up and introduce Josh. It's a contact of his, so we're just meeting Josh for the first time. Super excited about what he has to present to us. So come up and give him an intro and we'll get him going. And then I'll try and figure out your slides.
Perfect. Hey, everybody. So this is awesome. This is going to be a great training. Josh McGreary is not only a very good friend of mine, he's been an awesome mentor. He moved up to 𝐓𝐸𝐬𝐬. How long has it been now? 2 years? 3 years? Yeah. Yeah. So it's been a while. We built a really awesome relationship. He's been in the real estate game for a very long time now, primarily in the mortgage space. And he now is doing residential and commercial loans. He's got a lot on his plate. He's really good at what he does. And I'm really excited for his presentation today because, I mean, this dude's just a stud. So he's a great person to just know. So just Josh, get up here and I'll shut up.
I thought Dave Lunch to say that. So.
Thanks, Dave. It's awesome.
Well, man, I am super excited to be here. I have heard a lot about 𝐓𝐸𝐬𝐬. You guys are just like crushing it here in Utah and internationally. So it's just a super fun brand, and I'm sure you guys are all just loving this market right now. Tons of fun. So we're going to be talking about real estate financing. I've got kind of a little bit of a unique perspective on lending, so we're going to talk about that today. Hopefully this will be somewhat interactive as well. So if you have questions, like let's totally talk through them. So first, 90%. 90% of millionaires have this in common. Any ideas?
Oh, real estate.
They built their millionaire status through real estate.
I was gonna say tax problems.
Yeah. Yes, that too.
All of the above.
They need a good accountant, right? And real estate appreciation. So 90% of millionaires across the world have built their wealth through real estate investing. So my goal for everyone here today, if you're not already doing this, I want to help you tap into that market so that you can increase your demographics. And what's the thing about investors? They are always buying, right? Which means really good for you guys, right? So my job today is hopefully help you grow by around 25%. So we're going to talk about that. Real quick about me, like Dave mentioned, we moved up to 𝐓𝐸𝐬𝐬 almost 3 years ago. We just had our 6th child, Augusta Quinn over here. And we love just going on adventures with our kids. So we've got a big motor coach and we travel and show our kids like the Redwood Forest, right? And have a ton of fun, dirt biking, skiing, that kind of stuff. We just love being outdoors and borrowing Dave's paddleboards. That's right. Yeah, so tons of fun, love what I do. I've been in a lot of different kind of financing, almost $6 billion funded in my career thus far. And so I used to be in the private equity space. So actually a firm that's not too far from here. And so real estate development, real estate acquisition for multifamily and commercial funded, also we had a large private debt fund as well. And so then switched over, continuing on brokering commercial loans as well as residential loans. So we're going to talk through a couple of things, but so I have a major goal for today, and it's all for us to walk out of the room like this guy.
Hi, Mr. Schott. It's Peter Brandt. I apologize for my call earlier. Really asked me to call you back for something that will line. Billy says he needs $225,000 for Ricardo income. Please. Yes, I added the please. Okay, let me hold on 1 second, please. Okay, so Billy says he'll pay for rent code himself, but when he sells them for more money next year, he's keeping the profit.
That's the move right there. Zap, and it's like awkward, like, yeah, yeah, come on, right? Like, so that's how we should all be leaving this room today, is like excited to go tap into this awesome market. And hopefully. Okay. Perfect, thank you.
Oh, I went back. Thank you.
It's all right, we just want to see my family again.
Yeah.
Perfect. So a couple just outlines for us real quick. So some fun facts, some residential versus commercial differences in the lending industry. You guys are all used to debt to income. We're going to talk about the commercial side of that, which is DSCR, or debt service coverage ratio. Just something you guys are really going to want to know as you're working with these investors. How to help them increase their lending capacity, choosing the right loan, and then would love some questions at the end. Okay, so these slides are like very word heavy, so I apologize. But just some really like interesting facts. So in July of this year, 4,500 homes were sold on the MLS, of which 1,159 were multifamily units. So that's 25% of the homes sold in Utah were for investors, right? So when I say increase by 25%, I'm letting you know that 25% here in Utah are for these types of investors. So, and they probably bought multiple homes, right? So that's only 1 month. So I want to help you guys tap into that market. Secondly, the Urban Land Institute ranked Utah as the nation's 3rd best place for development. So you guys have probably like been driving around seeing all of these huge apartment complexes going in like everywhere, right? Reason being is there's awesome tax incentives for Utah. Plus, if you keep reading on in that, companies like Goldman Sachs, Adobe, right? All of these amazing companies are moving to Utah. So there's this huge migration from places like California. David, I don't really like them. It's okay, it's all right. And so it's just growing this major growth center here. In the next slide, I'm going to talk about some of these areas, but this is a townhome project I'm doing right now. It's 88 units in Ogden, huge tax incentives in Ogden. So this developer bought the land. We're going fully vertical, and then these will be for sale. So these are happening all of the time. So a townhome in Ogden going for $350,000, right? So these are awesome places for investors to go buy those 2, 3, 4 at a time and have rental Airbnb stuff going on there. So we're going to talk more about those. A couple more fun facts for you. As of August, so just recently, the average rent for a 1-bedroom apartment is currently going for $1,150, which is a 16% increase from last year, right? So for investors, yeah, the home prices are kind of going up, but the rents are matching it, right? So that's important to understand. And then you can also see for a 2-bedroom is $1,400 and 3-bedroom is $1,865, which is a little bit of an increase, but not as much. So these 1-bedroom apartments are for sure skyrocketing here in Utah. And I think that's because a lot of single or couples are moving here from out of state to come get a job. And so really good opportunity for investors. And then for year over year growth in like certain areas. So you have South Salt Lake and Murray that are tied for #1. So like South Salt Lake, if you go apply for a multifamily permit, and it's like a feasible, like actual, like doable project, it's approved. Like South Salt Lake is really wanting these types of investments here. So that's up by 15%. And then Ogden, 12.5%. Tons of stuff going on in Ogden. Ogden per capita has been historically like the lowest poverty level in the entire state of Utah. And Ogden is really trying to change that. And so they're giving a lot of tax incentives to bring people there to kind of increase jobs, opportunities, that kind of stuff. So they're helping these developers really come in and get these. And then Salt Lake went up by 4.8, which is not huge. That's kind of just natural growth. Oh, I'm sorry. Let me go back one. So that picture here, so this is for, we just closed on this deal 2 weeks ago. It's an 8-plex. This lady bought it for 1.6 million and is going to go in, increasing the average door by $450 in rent per month times 8 doors. Yeah. And that's market rent, right? So she bought it for 1.6, put 25% down. We closed the loan in 45 days, right? So pretty amazing opportunity, cash flowing, really great apartment complex with not a lot of need to upgrade. Okay, so difference between residential loans and commercial loans. So a residential loan for like multifamily and most of you probably know this, but it can be 1 to 4 units. It can be a long-term lease. It can also be nightly rentals. We can do fix and holds. So we've got construction products that we can go in, remodel, and then it's a switch to a perm loan, which is really nice. Also do fix and flip type loans as well. And then any given individual can have up to 10 residential loans at one time. After that, they have to switch to commercial. Does that make sense? Got it. So commercial loans in multifamily is 5 or more units, can be long-term, it can be nightly rentals. Commercial loans also include like commercial shopping centers, office space. So like somewhere like this, right? So you had to go get a commercial loan from a local credit union or bank or whatever to buy something like this. Triple net. Are you guys familiar with triple net? Yes, pretty much everybody. So a triple net lease is basically an investment, like for example, Walgreens. Every Walgreens in the country is a triple net lease. So they sign a 25-year lease. Someone guarantees that rate of return for the next 25 years is generally what Walgreens does. But like 7-Elevens, CVS's, these types of places are triple net lease commercial loans. And then hospitality would be another category. So, okay, qualifying. There's a little bit of differences for qualifying for a residential loan versus a commercial loan. So you guys are all very familiar, right, with residential loans. So credit score, obviously a big factor. Loan to value is a big factor. Your debt to income. So that's one major hurdle for a lot of investors is being able to qualify enough income to get up to 10 loans, right? So we're going to talk about some strategies on how to help your investor clients make sure that they're able to increase their capacity. And then obviously the terms are pretty straightforward, you know, generally a fixed, 15, 30-year loan, fixed rate, all of that kind of stuff. And generally for 2 to 4 units, it's 25% down. But for a single unit, a lot of lenders will allow 20% down. So that's good to kind of understand. 20 for a single, 25 for multi-unit. Okay, commercial loans. DSCR. My next slide really dives into debt service coverage ratio. That's like the equivalent of debt to income, right? But it's making sure that the asset can cash flow the debt on the property. We're going to talk about that. The next one is guarantor strength. Okay, so when we're looking at this, they are looking, okay, is this going to be like their primary office or is this an investment where they're leasing it out to someone? Is it to one tenant? So if that tenant decides to leave or goes out of business, do they have to cash flow it? Or are there multiple tenants in there that cash flow the property really well? So they're kind of looking at guarantor strength. Do they have some other income? Do they have other assets? Are they new to this? Or are they not? So everything generally, when you're purchasing, is always based on LTC or loan to cost. Okay. So they don't go off of loan to value. They always go either off of the purchase price or the appraisal amount, whichever is lower. Okay. So that's important to understand. And then strategy wise, this one, I don't mean to go too deep into it, but the strategy here, and this is again for growth, right? So if they have to come in and let's say that they're buying a sixplex, right? So they come in, they have to put 25% down, but they're gonna make it look like this back here, right? They're gonna do all these upgrades, tear out old nasty carpet, bring in new appliances, build a playground, whatever. That will look at loan to value upfront. Okay, so this is a good one though, just to make sure we're able to do that. The other major difference, no commercial loan goes for a 30-year straight fixed. You have an amortization amount, then you also have a balloon payment. So the amortizing amount is like a 15, 20, or 25 year. There's rarely any products that go 30 years on a commercial loan. So that helps you understand your payment, but then you have the balloon payment, generally 5 to 10 years. So why would someone pick a 5-year fixed or a 10-year? So for a 5-year, maybe it's something they're going to come in, they're going to increase rents, they're going to make it look like this, right? Way nicer. And they're going to hold it for 2 or 3 years and then sell it. So they can get a lower rate, generally around 3.5% for a 5-year term, right? Balloon payment. If they go 10-year, they're probably looking at like 4.25%, but it's fixed for 10 years. So, and again, it's either amortized on a 15, 20, or 25-year amortization. That's how we figure payment. The other thing too is no commercial lender collects escrows, right? So the investor or owner of that property is liable for the insurance and the taxes. So we never factor in escrows like we would on a residential loan. Okay. Any questions real quick on that? I know that's a lot of information. Okay. Debt service coverage ratio. Has anybody here ever dealt with this before? Okay. All right. So it's not as daunting as it looks, right? So again, debt service coverage ratio basically helps us understand, is this going to cash flow or is the owner going to have to subsidize it? Okay. So how it works is to find the actual ratio, you would take the net operating income divided by the debt service, which is the mortgage amount, and that gives you the coverage ratio. So in my scenario, the ratio itself is actually a 2 multiple coverage. Okay. So if we took 9,000 divided by 4,500 here, that's kind of in the way. That's the mortgage amount. We would have a 2x coverage ratio. Now, most lenders are going to say, we want our debt service coverage to be 1.25 or more. So we take a mortgage amount of 4,500, times that by 1.25 and gives us a 5625 coverage. Okay. So when we're looking at this, the net operating income is higher than the coverage ratio. So that checks a box for that underwriter, right? Meaning, hey, we like this loan from a cash flow perspective. It makes a ton of sense. You know, you're easily able to cover your expenses. Okay. So debt service coverage ratio. So replaces debt to income on a residential loan. Does that make sense?
Divided by 2 times 1.25.
Well, so there's a ratio and debt service coverage, right? So the ratio in this scenario is 2.
Yeah.
And the lender needs it to be at least 1.25.
Yeah.
Yep.
So 1.25 is the lowest it can go.
Yeah, so most lenders are 1.25, some will go down to 1.2, depending on the asset, right? So hospitality margins are actually pretty thin. And so they'll go off of like a 1.2. But for probably what most of you guys are going to be doing, probably like multi-unit, like multifamily stuff, 1.25 is a really good standard. Does that make sense?
Mm-hmm.
Okay. And then plus, when you're working with your investors and you go look at a property and you can run this for them real quick, and you're like, this actually isn't a good deal unless we can come in and add value and increase rents, right? Or dude, you have a 2.5 debt service coverage ratio, like we got to buy this 10-9, right? And so this can really help you when working with your realtors. Yeah. or with your
So
investors.
if an investor is buying a building that they're gonna occupy themselves, how much debt service coverage do they get?
Yeah, good question, right? So if you were the owner occupant, right? So you guys go open up your own team's realtor office. So how that works is they're gonna take your revenue minus your expenses and get a net operating income of your business and make sure you can cash flow that. Generally, most clients are already paying for rent, right? So I have a chiropractor in Utah County we've done multiple loans for. And so I can take a look at his business. He's been paying rents in other areas. And they've been able to say, man, he's paying $8,000 a month for these offices. He's gonna replace it with his own building and he only has to cover $5,000, right? So they are still looking at the same ratio, but they're underwriting his business.
So let's based off this history.
Correct. Well, both, right? So they're looking at former history of rent, or they're taking a look at his last 3 years of business income. And they're gonna say, hey, historically, this business has done this, this, and this. It's not decreased majorly. Now they do have overlays for COVID, right? So a lot of restaurants, as an example, they kind of are throwing out 2019. Right? So those are good questions, but they are going to look at business income. So, so everyone, this is Cami, by the way, if you haven't met Cami. So she's a mortgage loan officer as well. And we do some commercial loans together. And so we just are doing a new Betos out in Eagle Mountain. So Betos plus 3 other retail spaces with a drive-through. And on that one, they're like, man, you've been paying $9,000 in rent for, 10 years, where we can go build this building and basically they don't have to pay any rent because these other tenants are covering it for them. By the way, they do well off of selling breakfast burritos. Wow, breakfast burritos. So that's a freaking yeah. So I was shocked by that. So they're good. So, but that's a good question. So they are looking at like historical income and all of that and taking that into an account as well.
And then, sorry, I don't know if it's
Yeah.
question time or not.
Yeah, please, no, let's go. Let's lighten the room up a little bit.
So,
I like it.
how much of these commercial lends are coming from investors versus people who do own their own businesses that are losing for buildings?
Yeah, so I probably do 30% people, they're owner occupying it,
Okay.
right? And then 70% are investors that want other people to have their tenants.
Okay, and then is there any process that you have to go through for the leases that they have signed on checking those leases credit?
Not their credit.
Or their financials, their business financials, all that for any tenants?
Yeah, so this actually, like these little centers right here is like right next door is a really good example, okay? So let's say that you wanted to go buy that shopping center. The lender is going to look at, so there, and this is on my next slide, actually. It's not on my next slide. It's 2 slides away. So no, it's good, right? So when you're going in, I have some questions. These are like winning strategies. We want to ask for their rent roll, right? So we want to see who is paying rent on these units. We want to see, I ask for financials. Right? When I'm going to buy something, I ask for last 2 or 3 years of financials on the asset and make sure things are working well. It shows me maybe some liabilities or expenses every month that no one thinks of and maybe makes it not a very good deal. Right? So we can talk about that as well. But think about this. What if you had that, there's like this little one next door that actually has like an automotive center. What if it was like Jim Bob's Automotive Center, he's been open in business for a year versus a Burt Brothers that has like 30 locations.
Yeah.
So the strength of that tenant is pretty good or bad, right? So they are looking at that or like, hey, this guy wants to be a karate instructor, right? And he's like, can't even afford to like pay the mats. Yeah, right, like, he watched the movie, like, he's really excited about life, right? So like, that guy versus like, you know, like a Gracie Academy, you know, that has 3 locations.
Got it.
So they are looking at those tenants, they're not checking credit, they do wanna see how long the leases are. So for example, let's say we were gonna go buy like a multifamily unit and they're month to month versus 1 year leases, does add some strength to that deal. Does that make sense? So these are things that lenders are looking for, of just the overall like stability, I think is maybe the right word for that, stability.
Are you thinking about your own building with?
Both
maybe a
sides,
refi?
yeah, both sides, I know, I'm like.
I was gonna say, throw out your exact scenario.
Yeah,
Mike,
what's your
figure it
scenario?
out.
I know,
What's
I'm
the
trying
same?
all these questions, I'm like, okay, you guys should retire right now. No, that's good, that's perfect, and I'm thinking about it for both sides, that's great.
Yeah, so if you ever have scenarios or you're like out with a client, call me and we'll hop on the phone together, right? And it makes you look like a rock star because you've got a guy, right? So my like catchphrase is your mortgage guy, I got a guy, right? Call him up day or night, whatever, text me and we can go through these, but.
He's really responsible.
It's nice having a guy too, yeah, that's awesome.
Yeah.
Yeah, especially when the SAR page was off.
Yeah, yeah. Dave and I had a fun time hiking for a 80-year-old looking for mushrooms yesterday.
Oh,
Yeah.
It was fun. Nice walk about the woods.
Yeah, it was good. We had a good combo from.
Got my workout in.
We're talking about search and risk.
Yeah. It was good. So we'll get to that, but and we'll go into some other things. So when people are like, hey, I want to get a loan on this, like I want to go, there's a couple of things, these things that everybody needs to understand before we figure out what kind of loan to get, right? So on the commercial side, I broker all sorts of different kinds of loans. And so these are the questions I ask. How fast do we have to close? Do we have to close in 10 days? Or do we have 60 days, right? So I have people literally are like, I have to close on Friday. And it's like, okay, how much are you willing to pay for the cost, right? Are you willing to pay an 18% like all-in rate? Well, that's crazy. Well, you're crazy for buying an asset by Friday, right? So like, there's like this balloon, right? Like, is speed important and a higher rate, or is a lower rate with a little bit of time? So there's kind of this balance, right, that people need to understand. So speed, cost of the loan, a couple of things. You guys have all heard of like origination points, right? So in commercial, there's points plus interest, right? And so generally there's a point or 4 points, right? Depending on what kind of lender we're working with. And then there's the rate. So for example, if we were doing like a construction loan and it's a 4% origination plus 10% for a year, that amortizes out to 14%. Okay. If all of the money is drawn on day one, right? So, and then asset type. So, for example, if we were going to go buy a hotel, hotels did what in 2019? They didn't do great. Yeah. So it's really hard to go get that kind of a loan, and rates are a little bit more expensive versus, hey, we've got this amazing cash flowing 8-plex, got her a 3.875% rate, right? For 8 units with 1% origination point, right? Amortized over 25 years with a 10-year balloon. So it's just like this crazy, awesome cash flowing asset from day one. So that's pretty cool. The amount of equity. So the hard part is when someone calls me, they'll tell me how excited they are about this asset that they want to buy. My first question, how much equity do you have? Right? Because if they don't have the cash, we're not doing the deal, right? You can't finagle numbers. You can't like, well, but it's worth this. And so that gives me some equity, right? It doesn't. So it's pure loan to cost. So that's something that we need to make sure. And same thing with residential loans, right? They require, again, for a 1 unit, we went over this, for 1 unit, how much down? 20. For multiple units, 25. Yep. So same thing with a commercial loan, 25% down always. If they have more, great, right? For construction loans, 30%. For land, 40%, like minimum. For just buying raw land, 40% minimum for sure. Okay, so that's good to know. Guarantor strength, we already went over, and then location. So are we gonna, is it exciting to a lender to go to Mona, Utah, that's like population of 600, right? Versus Park City, right? And so location is important to the lender. And a lot of these commercial lenders, especially here in Utah, will only do specific geographical areas. So we have to kind of keep that in mind as well. Yeah.
Before you move on from this slide,
Yeah.
back to the speed thing.
Yeah,
Say somebody does need to close by Friday, if they do, they're getting a screaming deal or whatever,
right.
and they come up with either a bridge loan or hard money or their own cash. Or whatever, how quickly can you get them back their money?
Oh,
If they do the purchase and
yeah.
then they need to.
for sure. So if they can pay cash and then we just have to come in and refi it, 40 to 45 days to get like a really nice conventional loan, right? I always ask for 60 days so that I'm like not being held accountable for timeframes. But the other option is we do go hard money and get a 6-month bridge, right? And it is a little bit expensive, but you were able to get this really amazing asset for some reason. So it just has to kind of make sense why you're doing that.
That's
Yeah.
perfect. I was wondering if there's like a 12-month seasoning period or something
No.
like that.
Nope, not at all.
Cool.
Yeah.
And can you, for an investor,
Uh-huh.
do you have to look at their financials in terms of cash, or will you use just assets as
So
collateral?
I don't have to qualify them based off of their own cash coming into the deal. We do want to look at their financials to make sure, are they making 40,000 a year or are they making 800,000 a year, right? I do look at that. Or hey, the nice thing is too, if they have a really nice business, right? Or they have a partner that owns a really nice business, that's what we're qualifying them on. So that's the actual borrower.
Okay,
Now, the nice thing is for investors, and this is kind of getting into the weeds, so I don't need to go too deep, but you can actually form a new LLC. So on that 8-plex we talked about, it's actually 2 sisters that wanted to buy that property. So they formed a brand new entity, but the husband has a really amazing masonry business. And so we used that business to qualify them, but these were the 2 borrowers in
so
a
use
brand new entity.
use
with no
financials from
financials.
another building.
From another
as-
business.
Or from another business,
To
okay,
qualify them, but then the actual like deed to the property is in that LLC.
did his business have to guarantee it though?
Correct, that's what I'm saying. So that's the guarantor, and then this entity is the actual owner of the property.
Okay, cool.
Does that make sense?
Yep, perfect sense, thanks.
Cool. Okay, so increasing loan capacity, right? So I get calls every day. I got this really great thing, but I need to free up some cash. I gotta get that 20 or 25% down. So a couple options. We actually, a deal with Cammie's mom, who's a commercial loan officer. I'm sorry, yeah, thanks. So commercial real estate agent. So this property was gonna be really hard to get a commercial loan on. It'll be awesome with an actual like construction loan or whatever. So we actually just did a cash out refi on the house to then allow them to buy the property cash, right? So those are options. Other options, right? So we go up to 80% loan to value for people. So we can get them that cash out and then they can use that as a down payment for the next property that we're gonna go buy. So that's an option. Home equity lines of credit. There's some amazing options right now. Zions is running a first year 0.9% rate for your first 12 months. And then interest only for 10 years. So MacU also has some other really good ones. Golden West also has some other good HELOCs. I've got contacts at all 3 of those locations. So if we ever wanted to look into that, we can hand you off to a loan officer there for a HELOC. And then asset-based lines of credit. So how that works is, let's say you had 4 other properties that had some really great equity in them. I have lenders that can actually take that as like a second position lien And then you can use that for going out there as well. Okay, so increasing cash flow, right? So the whole point isn't to just go in and keep it to where it is. The point of buying an investment really, if you really want to build wealth, is go buy an underperforming asset, make it nicer, increase rents, and then do that cash out like we talked about. Like that's the goal. So each property, the way I look at it, and the way we did this in our private equity. So in the private equity space, own about 4,000 doors currently, and it's a 5-year cycle. So year 1, you're buying it. Year 1 to 2, you're increasing rents, you're making it better. Year 3, you look at a refi, right? Get out your added value equity out of there so you can go buy more. And then at year 5, you're evaluating. Do we really like this property? Do we want to keep it? Or man, the market's crazy right now, and we could make a 25% return just on that added equity, right? So whatever that is, and those timelines vary by how many doors. If it's like a 2-unit, that could be, the whole thing could be in 2 years or 3 years. So we're just kind of looking at that to make sure, hey, I want to go buy 2 investment properties every year for the next 5 years. And I want you guys to be their realtor, right? Like I want you guys being able to be competitive. We just go out there, they know exactly what it is. I already have all their docs on file and I can get this done really fast for you. So those are some options. Any questions about any of these 3 things? Just think about it. I'm waiting.
I'm just waiting for someone else to ask a question.
You just ask them all.
Yeah, let's hear it.
So this is more to do with like, I guess, market trends. I don't know if it's like exactly on point, but what is the market trend like with commercial following residential or vice versa?
Yeah. So to clarify your question, just to make sure I understand correctly.
So housing market, like residential housing market has been crazy, right? The last year and a half, however long.
Yep.
Commercial hasn't been as crazy.
What kind of commercial?
Office space, like office buildings.
For sure. Yep.
So I'm wondering, because that's what I own. I own 35,000 square foot office space building.
Okay.
And I'm like, I would love for that to do what residential has been doing. I'm just wondering if it's going to follow the same similar trend.
This has 0 statistical value with what I'm about to say.
This is an opinion.
Yeah, this is an
Okay.
opinion.
I want
Yeah, let me turn this off real quick.
I won't hold you to it. I
Yeah,
won't hold you to it at all.
I don't think office is going to really like increase. I think people are for sure still going to want office space. I think a big trend is like the leasing out, a smaller office, 1 to 3 offices per company with a really nice conference room that they can rent. Right? I think that model is working really well. To me, that's the Airbnb in the office space.
I've heard that works really well. So
Yeah. Yeah. So that's something interesting. I'm working with a developer right now that bought a huge office complex and they're converting it all to that flex space.
Like salt mine or something like that.
Awesome.
Yes. Yep. Exactly. Yep.
Really helpful. Thank you.
Yeah, you bet. So that's my opinion though.
Cool.
Yeah. But I do think retail, like restaurants, and some of these other like boutique type shops are still blowing it out of the water.
Okay.
Yeah.
Hey, Josh,
Yeah. Cool.
that same
Robbie
question.
West.
Yeah. Hey, that same question you just asked, but what about dirt or land? Is it going up like residential?
Yeah, for sure. Especially that's already pre-zoned for commercial. So just so everyone's aware, Robbie is one of the best automotive dealers in the state of Utah. Just had massive growth. And so going out and buying land right now and land banking, I know a lot of investors that are doing that. Land is probably the single most tough loan to get approved if you don't have a plan within a year to start building, right? So that's the like caveat. So if you, like, for example, Robbie, if you were ready to go buy a piece of land in West Valley on 2 acres, and then within a year, we're getting a construction loan for you, that's pretty easy. Does that make sense? But if you're just gonna go buy land to just sit, really we're underwriting your dealership. And, you know, so you would have to be able to like cash flow that whole asset. So does that answer your question?
Yeah, and the value has increased over the last 2 years, higher than normal. Is that correct? Okay.
Yep, for sure. Yeah, especially what's called infill areas, right? So for example, Robbie's on Redwood Road and what's your south?
3,700.
3,700. So there are some infill spaces in that area, a lot of multifamily going in, a lot of more like commercial properties going in. So that'd be considered infill versus like Payson 5 years ago, right? So people who bought land in Payson 5 years ago, Saratoga Springs, like super pumped, right? So like, for example, Ivory Homes bought 900 acres in Saratoga Springs like 5-6 years ago. Phenomenal return, right? So those types of investments are really good. But I do think, I don't see this huge bubble, right? I personally don't see like a 2008 happening again, my opinion. I think Utah is in a particularly awesome area from the standpoint of there is so much economic growth happening here. I actually think it kind of gives us a little bit of a Kevlar vest where we do have really big companies here, a lot of demand, really good high paying jobs. Utah, I think this is the 5th or 6th year in a row rated #1 state for entrepreneurship, right? So a lot of new businesses starting here, a lot of just general businesses here. So does that answer your question, Robbie? Okay.
Yes, sorry, I muted it, but yes, thank you.
Thanks. Okay, so next slide, possibly. Oh no. Okay, so this last one is kind of what we're talking about, right? So some winning strategies. Before, if you're gonna go help someone go buy a fourplex, we do the exact same underwriting as if we're buying someone's primary home, right? And I do all of that as well, not just commercial, but we're gonna want to make sure that we are doing a really good job pre-qualifying them, right? I wanna know every source of income. So it's me, Jennifer Clayton, and then my loan assistant is Alec. And so we're gonna work together to make sure we've underwritten your client. So when they go, the selling agent still calls me, even in commercial, says, hey, I see you have a pre-qualified letter here. And I say, no, sorry, that's a pre-approval, right? Like, I know I can get this customer approved. I have his or her last 3 years of tax returns. I've gone through, other assets that they have. I've gone through this actual deal and it cash flows well. So we're ready to go, right? And so that does give the selling agent a little bit of like, oh, they're like really qualified, really ready to go. So that, because I'm on your team, right? So we want to make sure that there's a lot of confidence there. So we do a lot of pre-game, work, so that when you go under contract, it's very fast, very smooth. Time frame, that's another big negotiating factor, right? I'm sure you guys are all seeing that. Like, you're probably calling up whoever you like to use for mortgage and be like, how fast can you close? How fast can I put this in the rep C? So generally 21 days on residential, okay? If you can get me 60 days on a commercial property that's like 5 units and up, that's very doable, right? And there's a lot more due diligence in a commercial loan than there really is in like a duplex, right? So set your due diligence period out a little bit farther than you normally do on a residential loan, right? So, because there's a lot more stuff involved in a bigger asset. So those are big things to just think about. And then due diligence, this is what we were kind of, you jumped the gun.
I know, I shouldn't have asked.
Right, so again, ask for the current rent roll, ask for the lease contracts, right? I want to know like the actual details. Like, for example, you probably have like increasing rents, like set in stone, X%. You also have like cams and stuff probably, right? So all of these different things in there that you really want to know the details of the contract, because you don't want to move in and be like, 5 of my 9, renters are moving out next month,
Right.
right? That doesn't give me a lot of warm fuzzies when we're underwriting. Yeah, so, and then also, like we talked about expenses, that's super important, right? So if there's like some major expense, like deferred maintenance, or there's some expense like you didn't understand before you bought this property, we just really want to know so that we understand the true net operating income of the asset, so that this is a good deal for your investor. So like Cammie's mom has called me several times, we'll dig into it, and I call back, I'm like, okay, don't kill me, but I'm not sure this is the asset that your client should be buying. I'm talking to you first as the realtor, but these are the reasons why. Can you go back and ask these questions? And then it's like, we just avoided a $2 million mistake, right? So like, that's part of my role, is to make sure I'm helping you like inform your clients of really good investments versus poor quality investments. So let's just really talk through that. Totally happy to answer those questions, at any time. Okay, so that was a lot of information, both on the residential side and commercial side. It's a super fun topic for me, at least. So what questions do you guys have?
So going back to the line of credit, the HELOC, and then you have the asset, what was the other one called?
Asset-based line of credit.
So what's the difference?
Okay, so a HELOC would be, or let's say a cash out refi. A cash out refi would be a specific asset. We're doing a new first lien position on there, and we're just taking cash out up to 80% loan to value, right? Versus an asset-based, or I call it also like a collateralized base. So they're taking second position on several other assets to then qualify for this other asset, right?
And that becomes like a HELOC.
Only in the perspective of it's like a line, like it's a line of credit that allows you to use for other properties. But they do take a second position lien on all of those.
It's just like a portfolio.
It's
And you can do
yeah,
first
that's a great,
position
yeah,
too,
portfolio
right?
HELOC.
You can do first position too.
Yeah, for sure. If you own it outright, for sure.
So so like I don't have a loan on this building, and I've got other rental properties that don't have financing, so I'm not interested in the refinance. I
Yeah.
don't necessarily want to put the obligation on there, but I want access if we need it.
Yep.
Could you do a portfolio product that's one loan that might be including 10 different properties?
For sure.
And what's the
Yeah.
LTV on that?
Generally like 60% LTV. So it'll get you there, just simply because they still want you to have like a really good position, because they are a little bit more at risk in second position. Now, in this case, it'd be a first position,
yeah.
but oftentimes most people don't have assets cash, right? Like most of my investors hardly ever use cash because they can leverage and go buy 3 times. So for every $25, I get you $100 in debt. So that's like the real buying power of that, but we can certainly talk about like those scenarios and do a portfolio HELOC that will allow you to go buy other assets.
What would the interest rate be on a product like that?
They're a little bit higher, more like 5. So oftentimes like a cash out refi is better because we can get you like 3.875.
But if they're paid off though, is that gonna change the rate?
No.
So the LTV and our-
Is the LTV still captivating on those?
It is, yeah. And a lot of them it's 75%. So on investment, if it's another investment, it's 75% LTV.
And now it's commercial only.
Commercial and residential.
Okay.
Yep, so if you're taking it out of your primary or a secondary, you can go up to 80% LTV.
Okay.
If it's listed as an investment property, it's up to 75%.
Okay.
Yep, good question.
On that line of credit product, what's
Yeah.
the time frame on it? I mean, is it only good for 10 years?
Oh, yeah, good question. So it's the same as like a home HELOC, 10-year interest only, 20-year amp. So 30 total years,
Right.
but you can refinance it,
Refinance
yeah,
every whatever you.
9-10 years, yeah.
So why wouldn't you just be able to use the asset itself? Do you have to get cash out, or is it interest rate?
That's for your down payment, right? So the other down payment has to come and be in cash.
Okay, but you can use the asset to come up with the cash
Correct.
to the down payment?
Yep, for sure.
Okay.
See, that's the thing, right, is we're not, on commercial loans, most lenders are not verifying where they come from, just like they do on like primary residence, single family unit, right?
They don't verify it.
So
They
commercial.
don't legally have to.
Nope.
Oh, that's got it.
Right, so like the thing that's crazy, right, is like each lender is like has their own guidelines.
Okay.
Whereas like if you came and it's like, well, it's Fannie Mae, right, guideline here, gotta be 75%. So oftentimes I'll go to the whole board and be like, hey, look, here's the reason why this guy's been doing this or this gal's been doing this forever. They've got this, this, and this, and this. You guys need to understand what's happening here. And then they can kind of break their own rules,
Okay.
right?
And then if
but
I'm
each
coming
lender-
to you with one of those, like that situation, are you still able to use an asset if I hold that property in an LLC that I own with someone else?
That other person does have to sign off. So we're gonna look at your articles of incorporation and your operating agreement.
Okay.
So you may have to do a revision in your operating agreement stating that you can use your portion of that asset to qualify for another asset.
Okay.
Right? So we just bought half a city block, one unit at a time in downtown Salt Lake. So, yeah, it was crazy. Yeah, so, but their main business, we had to do that same thing. And she wasn't super interested in like, so we had to go really deep dive with the lawyer, get just stating like, hey, she has no, they would just come in and be a partner in that business versus seizing the asset. So we'll work through that, but I've got really good real estate lawyers that can help with that if we need to.
Okay. Awesome.
Yeah, okay. Any other questions? Residential, investment, commercial?
Josh, I'd say just mention a little bit more what you're doing with jumbo loans too.
Oh, yeah. So pretty amazing jumbo product for residential loans. So we can do 10.01% down and rates are like 3.375, right? No origination charge. So $1,055 underwriting fee. And the biggest thing is no PMI for your borrower, right? They put 10.01% down, no PMI, they get into a jumbo loan. So anyways, that's pretty big, especially in Summit County where we live, like Park City, Heber, Oakley, Camas. We're doing a lot, pretty much every loan I do in those counties are jumbo loans. And to be able to get into that big of a house and not have MI, it's great product, it's pretty big. So anyways, pretty fun. And closing time still is like 18 days on average on a purchase. And they'll allow cash outs up to that amount as well. So a lot of people are doing like cash outs on their jumbo loans because especially, Park City, these areas have drastically increased. So then we can go buy a second home for them at St. George or whatever. So really good to understand. Thanks, Dave. That's a good point. So anyways, what other questions? The board you to death, probably.
It's been awesome.
Awesome.
Yeah, ask online, see if anyone's got anything.
Yeah, anybody online have any questions?
Yeah, I have a question. So is this something that is national? We got some
Okay,
people that are in other locations.
Yeah, so residential currently only licensed in Utah. We are expanding out to, let's see, Colorado, Arizona, Wyoming, Idaho. So we'll have plus Utah, so 5 states for residential. But for commercial, I can go anywhere in the US. I really don't focus much on like Florida, right, or New York, right? So if it's like Intermountain West, I'm really, this is gonna sound cocky, I'm really good in the Intermountain West, but lenders don't like to lend, that I know here, don't want to lend in Florida.
Oh,
So.
that's a bummer. Sorry, Joab.
Is your she in Florida? Bummer. Well, I can't be everything for everybody.
So we don't want to like sign off.
Yeah, exactly. Sorry.
Wasted it now.
Oh, that's funny. Good question though. Thanks for doing that. So my commercial side, this was on the first slide. So it's my own brokerage called Timberline Loan Brokers. And then on the residential side, it's Altius Mortgage. is who
Did you have a
my license is
contact
with.
slide?
Yes, you bet.
Get to that.
And
That's
did
not
you,
gonna be in front
did
of
we
yours.
record this whole thing?
Oh, okay.
Oh,
Yeah.
I have a question for you, if that's okay.
Yes. Go ahead.
Okay, sorry, I just didn't want to interrupt. So I've been multitasking and listening, so I'm so sorry if you've already said this, but I just noticed, so my question is about hard money lending.
Yeah.
And then also nightly rents, just because I have clients that are doing a lot of investing and then they're doing short-term rental.
Sure.
I noticed nightly rates as well. And then just the hard money lending, because their problem has been that they've been getting approved on their own. They pull HELOCs and then they buy properties, obviously. But meanwhile, if they're, renovating and getting them finished and all the things, but they find another property in between and they're like, oh my gosh, I want to pick that up. But like my HELOCs and things are tied up at the moment. Then
Yep.
how would that work for them, say through you, if they needed like a hard money or like a bridge or something?
Okay, so does everyone know what hard money is? Yes, okay. So
Sorry.
rates are like pretty astronomical, right? But again, time value of money, right? Or opportunity costs, right? And so those are things to be thinking about. I actually have a lender based out of Oregon. I think we have someone on here from Oregon. So he's based out of Oregon. He's done 4,000 single family fix and flips. And he's got a $800 million fund that he does partnerships with. So he'll come in and he will pay for 100% of the purchase price. He'll do 50% of the renovation. You pay for the other 50% of the renovation. So for example, if you bought this home for $200,000 and needed to put $100,000 worth of work, you only have to come up with $50,000, and then you guys split the profits, right? He has another product, if you've done multiple loans with him, that he'll actually drastically decrease the amount of cash you need to bring in if you've been a good performer in the past. So it sounds like the clients you're thinking of probably do several per year or even several per month. So cash flow is a big deal there. So we do have some lenders that require less down. Some require 5 to 10% down for these like people who are doing this full time, right? It's a little bit different though if they have a full-time job and they're weekend investment warriors, right? So if they're doing maybe 1 or 2 a year, that's a little bit different. But if you have people that do this for a living or semi for a living, then there are some other options out there with less money down. So they always have to have skin in the game though, right? So I can't ever really do a loan, nor would I just personally allow someone with no cash in a deal. Because then they're just I'll just walk away, right? They have no investment in it. Does that make sense?
Yeah, so not really a great option. Nobody will bridge them or help them if they know that that'll be freed up shortly. And they,
I mean, there are equity groups out there that will come in and partner with you. I don't personally ever source equity. I can, but I won't. I had a buddy that went to federal prison for 15 years for a deal that went sideways, and all of the investors came after him. And I have six kids, so I definitely don't want to go to jail. So always just focus on the debt piece, but there are some investment groups that'll come out there and do a partnership with you. But in that case, you are giving away anywhere from 25 to 50% of the equity in the deal. And it's probably not going to make sense if you're doing that plus hard money. So they probably just either need to get a good equity partner that gives a pretty good rate, or they need to slow down and do it really well and build up their own cash. So, and I don't know your name, but hopefully that helps.
yeah, no, that's great. I appreciate it.
Yeah, you bet. Any other questions? I know my time's almost up, or it is up, but any last question? Okay, again, I want us all walking out of the room like that guy from Moneyball. Yes, just so stoked about life. And I want you guys to tap into this extra 25% here in Utah.
That was awesome, man.
Yeah, thanks.
Good info, huh, guys?
We are
wrapping up this portion. Last chance for questions. I'm gonna let Josh off the hook here. Good to see y'all. I'm gonna shut this off. I will turn it back on when we start our next segment, when we go over the EXP overview, but we're gonna take a break right now. I think we have some lunch being
Yeah,
delivered
that
or
should be
something.
here soon.
So, okay, guys, thanks for showing up.
Bye.
See ya.
You guys don't like R&R